So today's topic is on bias, emotions, and intuition in quantitative finance or systematic trading, however you want to take it. Um, and we always start with a disclaimer. So, disclaimer: this is not financial advice, only my own and other speakers' personal opinions. This is not to encourage nor promote taking any trades, positions, or investments of any kind. Any information contained in this conversation is for informational purposes only and to be taken as is. Derek Wong and other speakers have done their best to ensure accurate information, regardless of anything to the contrary. Nothing available in this conversation should be understood as a recommendation. Consult a financial professional in your jurisdiction. You know, well, I don't see Daquan from last week who submitted this topic. Uh, Maybe he'll join later. So I guess I will spearhead this anyway. Um, so I have a couple of outlines about this, and I do think that emotions in systematic trading is much different than you get in, say, discretionary trading. There's a lot of books, trading psychology. Brent Steenbarger is one who's pretty active. I think he's got a ton of books. And then you also have like people like Denise Shull, performance coaches in trading to help you improve yourself. And some firms are spending quite a lot. Famously, Point 72. They have their own in-house performance coach teams that enhances their traders' performance to make sure that they are doing their best. So I think that this is an interesting topic, and specifically in the quantitative realm, because we are not the ones taking like the discretionary decision, and that it can be helpful that we have this algorithmic barrier or systematic barrier in between us and the markets. But I would almost say like it's a lot harder to deal with. The emotion and trying not to step it on your system, changing your risk metrics, changing your leverage, changing these things, because I mean it's going to be in a drawdown, or on the other side, kicking up your leverage um, because you're doing well in a non-systematic fashion. So maybe we can open it up to some experiences some people have had either dealing with bias. This could be cognitive bias or data bias, or emotions or intuition in trading, and then I do a bit of a roundtable. I guess I should point to someone so that someone knows uh, how to talk. So I'll go with Bruno C first.
Okay, put me on the hot seat. And I have really brief experience in trading. I believe you guys have a much wider experience than me. I'm learning to cope with my emotions. I do feel that my this emotional issue is much more important in the trading activity to my discretionary friends. I feel that they need to be on their top psyche every day to perform well. And on our side, on the systematic side, I do agree with you, Derek, that it plays a different it plays differently this emotional management. Uh, the problem is that we deploy our systems, and once they're on, we're not we're not making any decisions anymore. Uh, the decision we can make is to shut them off, but until then we are just watching them they perform. And I think the it's similar to the emotional drag that a CIO would have when he brings a new trader to the team. And but the difference from the CIO perspective is that if that trader that he brought doesn't perform, he can fire this new trader, and and it's all good. It just brings another new trader and starts from scratch. But from our side, when we see our systems going bad, we don't we we have only ourselves to blame, and I feel that this is where emotions start playing a huge role, because you start doubting if the systems are correct. You start doubting if it's not if something you missed, and then that problem that emotions have, that they surpass your intellect. They start You start talking only with them and not with your rational side, and take bad decisions. Don't know if I was clear enough, but I think this is the thing. In To sum up, I think the difference is from the time window is different. For our distractionary friends, they have to be good every day, but from our side, it's something that accumulates this emotional drag.
Hi to everyone. Very happy to be a part of this conversation as always. I'm happy to be involved in such conversations and projects. I want to say that I thought about this, and I want to say that I think that intuition can be useful for searching the ideas for trading, and maybe for adding new markets or something like this, but not for trying to predict the future. And emotions are okay on backtesting maybe. If so, for example, if I have a lot of emotions, I start to backtest instead of doing something in discretion way. In my trading, when I was younger, maybe 10 years ago, when I started to trade, only have had few years experience, I maybe was led by emotion for sometimes, but now I understand that it's very, very bad idea. So I understood it maybe 6, 7, or 8 years ago, that if I have too much emotions, I start in, of course, it's maybe in a drawdown or maybe in a profit period, I start to backtest, or I just look at a market chart. I just look at a market chart and see how it works. Just here's my point.
Very interesting, guys. I will touch on Bruno C's comment first, that the idea of being a CIO with a team of trading strategies, assuming you're in a multi-strat world, and then the difference between firing a person and then dealing with your system, which may, a bad analogy might be your baby. You have spent hours, man hours, and data and processing time, which is similar to what you would need to train that person, can lead you to take bad decisions on dealing with it. And having a systematic way to deal with systems going sour, I think, is really important. And maybe that's something how, we will always have these reactions, but putting a system in place, the more hurdles that it has to go through, um, the less our human emotion will get in the way, and that is potentially an edge. Going on to Oleg's point, intuition is useful on trading ideas. Yes, I believe this. That is where experience comes in, and I think nowadays, with people cranking so much data through so much ML, they have lost the feeling of the market. I mean, for me, I was a runner on the floor at Chicago Board of Trade, and that really formed my intuition on how markets work, how prices moved, because I could see the order, I could put it in the market, and the price would move. Or you would see the market react to these orders. Um, Now people are staring at a lot of screens and charts, and I think that in the retail crowd, probably a lot of people are watching this YouTube nonsense. Um, but I do believe you see patterns in things, and specifically, I'm talking about flow-based trading. So I don't know how many people here have been on a large desk or identify mispricings in curves. But that is intuition where you've seen something, it's mispriced, and that it shouldn't be. And I think an example that I've seen recently, I think today's curve or yesterday's curve, is the German Bund. The 50 year maturity is overpriced versus the 20 year, as in it's giving you more yield. So now there's a bump in the curve, and that shouldn't happen. That's not how fixed income works. And the Bund is a very liquid instrument. And there's an intuition there that, okay, maybe there is something. And then the something behind that bump is actually the bond that is sitting in that 15-year spot is a very old bond. It has over 3% coupon. So now the normal bonds that are being printed and issued at these maturities are zero coupon bonds. So there is a reason that's happening, but you have an intuition to look at it. You can look at it and you can like dig into why there's certain things happening. I'm not saying that's like a repeatable trade or anything, but looking at that, looking at why something is happening, does open doors for you to dig into things that reading a book necessarily maybe won't tell you, and it allows you to be more opportunistic to see things changing.
Yeah, just a quick comment. I think this goes hand in hand with what Rob Carver talks in his book about ideas-based systems and just what's the word he uses? I don't know, numbers name based systems where you just throw everything to the wall, see what sticks, and decides that that's a system you want. This ideas based systems, they need this intuition Oleg talks about, I believe. But then you go to our models, go to our computers, and try to systematize it and see if this intuition has any merit.
By the way, I want to say an interesting point that a lot of I have heard opinions of few traders, and Rob Carver is one of them. The second one is one Russian trader, don't remember his name, and maybe a third trader exists, or maybe not, I don't remember, but a few traders said the same point, that if you, the mindset of average person is organized in such way, an intuition of our person, mindset of our person is organized in such way that he will lose money in the market using his intuition, I mean.
Bruno, I think the Rob Carver's definitions are ideas first and data first. The concept is exactly as you explained it. So idea first, you have an idea and you test it with data. Data first, you look at data and then you get some idea. Derek, you opened in your opening statement, you mentioned a person that I think has a lot of, or at least has had a lot of influence in my understanding of all this, this topic of emotion intuition, and is Denise Shull. And one of the most interesting concepts in her book, which is highly recommended if you ever listens to the nonsense that I spew out. The book is called Market Mind Games. Not just in the book, but in the book she outlines it very clearly. She's quite big on talking about fractals. Last week we talked about fractals in a mathematical sense, in a statistical sense. Here she talks about fractals in an emotional sense, and it's really interesting because her training, by the way, she's a neuroscientist of some kind, as well as she's been trading. So I think she understands she understands the business very well. And she talks about fractals in the concept of emotion, in the context of emotions, because she says that, obviously we keep repeating the same actions and the same mistakes. And so, that's the fractal nature of it. But also, so, the repetitive nature of our behavior, which is obvious. But also, fractals mean refer to something that is, deeply ingrained into our mind and our brains, and it has to do with, our upbringing, the biases, and all the things that sort of the baggage that we come with. And it's really interesting thinking about, those kind of fractals in the context of market fractals. And of course, her point is just how you deploy your emotional capital, which is as important as your financial capital. So emotional capital ties into your reaction to what's going on in the market, and understanding yourself helps you understanding the markets, because through your own fractals you can see other people's emotions and other people's reactions to market events. So it's really, really interesting. I don't know if I've ever remotely conveyed the concept, but if there's something that people want to dig a little bit deeper on, I think her book is
I haven't read her book, but I've watched a few interviews with her, and I find her approach quite interesting. In fact, I mean, I'm sure everyone here watches Real Vision. So there's one where like she's interviewed with the performance coach from Point 72, and they have two competing um, methodologies for dealing with trader psychology. And like you said, this fractal idea and this emotional capital, and he's coming more from like an academic kind of pure psychology method. And I think that really resonated with me because these things that we capture, if we are capturing something with our strategy, should be repeatable. And the only way they're repeatable is if there's some kind of fractal. And that means whatever is inducing this thing, whatever is creating this phenomenon, whatever is the underlying distribution that generates this thing, um, there's obviously a counterparty doing that. So they also must be affected in a repeatable way. So kind of my meta analysis of this whole thing, or like how I approach it, is one, I need to manage myself so I don't put the least amount of opportunity in the market, and I need to realize what the market is a collection of agents, right? I mean, this is from our conversation last week on complex adaptive systems, but there's this mass of people, and they repeat the same properties over and over and over again. And that does create this fractal nature. So I think it's quite interesting from a behavioral finance perspective to understand the individual trader psychology and what these coaches are saying these people are doing. And the people they coach are swinging really big money. And then looking at as like the ensemble approach, that actually the market, who's slinging the collective money of, you know, trillions of dollars, is also making the same mistake. I find that just kind of really
Yeah, and perhaps in a bit of trivia, which is a bit less relevant than Jerry's appearance in Me, Myself, and Irene. But Denise um, was involved in the production of Billions, the HBO series, and she's been working on coaching Maggie Seth for Wendy Rose role. So it's she's definitely got a bit of a stardom in her sort of career as well.
so. I mean, last few conversations. I mean, I'm kind of getting a feeling for the group and what we like to do. So how do we deal with this in a practical sense? Um, First, we need to think about the different aspects that is affecting us. One that has already been brought up is the backtesting research component. Coming up with a systems using intuition or um, executing against someone else's uh, cognitive bias or emotion is one. And two, making sure that we have some kind of processes that while we are running these things, um, we are able to take those decisions like Bruno C was saying earlier, firing these traders who are doing poorly and rewarding those that are doing well in a systematic way to reduce our own discretionary choices. So, how do you guys deal with that?
You know my answer already. Volatility adjusting. And this big thing that I keep calling a volatility model, and the need for having a quantitative and as objective as possible, expression of risk, starting from its own definition. That's why standard deviation is not it, and it's a much more articulated answer. But I find that having an explicit rather than implicit definition of your risk helps you, doing what Bruno was saying, have lots of different concurrent systems and strategies, and allocate and deallocate capital as market conditions change. As market conditions change. So I'm sure there's better ways, but the most practical way that I found is trying to kind of define a measure of risk, or define a measure of heat that I'm happy to live with psychologically as well, and then work backwards.
I'd add that on this issue of backtesting and developing new models, new ideas, or improving old models, I think that it's extremely important to talk to other people. Try to get your model criticized, put it to be beaten by other experts, by people whose opinions you trust. I think this is an important process, and to be honest, I feel that it's, in a way, it's part of what we do in these Clubhouse sessions. I feel this is an important feature of these conversations we have weekly.
For me, I think I take something similar to what Richard has mentioned, this like kind of adaptive approach. So there is the firing and levering up of a system is done on a rolling basis, uh, using different performance metrics, so that I am cutting the losing traders or reducing them to zero, but keeping them in my stable as I monitor them so that they can come back online as they may come in and out of favor. And I find that helps. The overall composition, though, I think is a different question. Like, if you imagine you have such a system that selects, adds, and subtracts systems and gives them their weights. The type of systems you're putting there is just as important as having that. Like, I have found that even though you may have put, say, 50 strategies into it, if they are all doing basically the same thing, then you're not really getting as much bang for your buck, so to speak, from that type of system. I have found it to be very emotionally relieving, because I know I have a system to deal with that and I don't need to really bother with it. But at the front end, um, talking about this researching part, I do get really attached to my ideas. I mean, I will blow months and months and tons of data on something, and I will keep digging and digging. It takes me a lot. There's one specific project I have in mind where it's like I wish I would have given up on that earlier, and it was just my stubbornness, my emotion, like not following sunk cost fallacy, um, that I couldn't do it, and it was kind of like just admitting that this problem was too hard for me, and that, I mean, it cost me and my team time, energy, and resources, and I feel bad about that, and I don't know how to deal with that, because I mean, it's not necessarily affecting the P&L of the fund at any point in time, but it's affecting the speed of innovation in the fund, because I'm forcing the team to focus on this thing. I don't know. Has anyone else had that type of experience?
Yeah, I think it's very common actually. There are things when, especially the most abstract, for lack of better words, or as you said, innovative things, concepts that are very underdeveloped or difficult to immediately turn into something practical. They require a lot of time, and yeah, you need to spend a lot more energy in order to recover something. And I completely feel for what you were saying. It just is this unrelenting quest for an answer that may actually be too much. And when is the time to just pull the plug? It's really really hard to define.
Yeah, I mean, I still have issues with it because then the question becomes, okay, what type of process could I put in place so I don't blow that much time again? And I don't actually have an answer for that because if I had solved it, I wouldn't be saying this right now. It would have been a success. But it's only at the losing all of that man hours and computation time that I look back and say, oh my gosh, I shouldn't have done that. And it's almost the same feeling like a discretionary trader has. Like they take this trade and then they pull out, and then it's like, oh my God, I have regret. I think it's it's like the same discretionary emotion that they have, but in a totally a different place because we're so front loaded um, in our work. Like we front load the data, we front load the processing, we front load the research. Once it's in production, it's basically um, fire and forget. But I don't know a lot of people who are discussing how to deal with like research man hour and processing time management.
Yeah, no, it's there's no right answer to the question that you're posing, and it depends on a variety of things, right? Probably management could be an answer. If they're willing to support you, management meaning, or also to stakeholders, not just your immediate management. If you're running your thing, it's obviously people around you. But um, someone may, someone may actually um, tell you that it's time to stop, and then you'll have to stop. But otherwise, it's yeah. I'm the kind of person that really, um, especially on seminal work, would never like to stop, because an epic fail gets you to the next success. And so just completely shutting down that work may actually be the biggest failure. So
Richard's been quite quiet, so I'm going to call him out. You've seen a lot of different types of traders in your work from all different kinds of backgrounds. What do you see as the most type of emotional or bias type of things in your experience?
Look, initially, sort of there tends to be a life cycle of a trader, which the first thing they experience is over leverage. That, of course, is highly emotional and draining. Well, the first thing is actually discretionary, usually associated with over leverage, and the emotional baggage associated with that does crazy things to your trading. And after you learn those lessons, probably many repeated times, because the first times you get hit by them, you think it's the markets that are at fault, and then you start realizing as you continually get dented that perhaps it's your fault, and then that sort of probably does encourage, it's a bit like sort of an aged wine, it probably does encourage you towards a systematic method where you recognize that you are a participant in the market as opposed to your desire to control outcomes in a market. So there's a psyche change where there's this degree of acceptance. And then you ultimately, I think, if you survive long enough, you hone in on a model where it really sort of
it fits in with everything you've learned, your experiences, etc., your level of acceptance of the market, and that's pretty well where you stay. And I must admit, when I compare my psychology now to what it was back in, say, 2012, 2013, I remember the stress, I remember the emotions that I used to go through in 2012, 13, but now I actually just don't experience that. I'm sort of a bit numb to it all, and I don't even worry about it. And so therefore, that allows me to invest all my time in research. I don't look at the charts. I might pop in, once every 2 days to see that they're all executing correctly. I really don't give much sort of creed to the charts at all anymore. So and because I'm applying a small bet size, wide diversification, because I'm talking in terms of the next 1,000 trades, perhaps that's the people always say I'm a bit sort of religious in my approach, but I think that's probably got to a point where my belief system just really doesn't care unless we're talking in terms of 1,000 trades, 2,000 trades. So this process of going down a systematic path, this process of acceptance, this process of you are a small participant in a much bigger system, this process of losing ego, these are all outcomes of your trading journey. And I think that you ultimately find you're in a very good place. When I look at Jerry's nature, very open nature, yes, he doesn't like losses. No one likes losses, etc. But it certainly doesn't dent his approach in any way, shape, or form. He's committed to this approach, and he keeps it. I see this with Tom Basso. I see this with all of these traders with a very long-term track record. There's this degree of acceptance. There's this degree of, happy with the model rather than continuously trying to improve it. But my research work is always burrowing down deeper into the underlying fundamental reasons for my approach. So I suppose that builds my confidence, but that's as much as I can say, Derek. And the reason I've been a bit quiet is there's not really much I can contribute in this conversation. It's very interesting, so I might just sit back and relax and take it all in.
Yeah, I am fully disappointed that the person who suggested this topic is not here. So we do our best. Maybe I will have to change how we come up with topics for the group, as opposed to taking suggestions at the end, as it may, let's say, not have a conversation leader. But then it's always good to be prepared. So going into these like kind of phases of a trader part, and everyone goes through it. Everyone deals with it a bit differently, and maybe I will give an example for myself because I know we've talked about meditation before as well, but the more big drawdowns I've been through, the easier it gets to not touch stuff. But I know I have to build these gates in between me and touching stuff, if that makes sense. I still find that I am really happy when we're making money. I like it. It gives me a rush, so to say, and I think that that's probably bad because not only like, there is some kind of personal identity with being a trader, with being a fund manager that I have, with my research, my systems going into the world and beating the smartest people out there with more money than me, being the underdog, that feels like so sexy to me. And then, if I feel that way, then obviously the other side, when things are going badly, are just as hard. And I think that's a personal thing, but that's really where I am. I don't know if other people have that experience.
I want to say that I was thinking about drawdowns, about this process in a psychological way, and I think that people can't handle, a lot of people can't handle a drawdown. It's hard for them because they associate it with failure, and people try to avoid in their ordinary life. a lot of people try to avoid failures at all, and they live average lives. They go to work every day. They not have a lot of big money. They don't travel, so but they afraid of failures. And if they live an average lives, they have no failures. Maybe, I don't know. But first of all, I want to say that systematic drawdown is not a failure. It's a part of our trading process. And also, I want to say that we must understand what failure is. That Ray Dalio and all businessmen, all billionaires, all successful people say have only one opinion on this: that failure is also a necessary part of our growing. It's a necessary part of our success. It is the way we learn, and we learn from the failure. Ray Dalio have a lot of interesting um, writings about this and a lot of interviews. That is a process, that success process, that we have a failure, understand why we have it, understand our mistake, and go to learn and go to growth. And as I know, even one guy, I don't remember who, maybe even all people know him, maybe not. He asked very famous businessman. I don't remember who exactly, but maybe it was Thomas Erickson or Henry Ford. And he asked him how to be more successful. And that famous person said, double your failures, and you will be successful.
I think that's interesting, actually. If we think about these failures in terms of systematic trading and quantitative trading, um, we have probably tested, all of us independently, so around 1,000 ideas or more. That's, I mean, easily for me, that's true. And I have learned from my failures. I learned what works, what doesn't work. But that introduces a kind of bias. It introduces an implicit bias, which is super dangerous because even if I keep track of how many times I've tested a system, or even if I do data segregation, or even if I do all of these methods, K-fold or walk forward testing or Monte Carlo or whatever, in my head, I have done thousands of tests. So I know kind of what's going to work, kind of not. So my research will push in the directions that I intuitively know um, should have a positive outcome. And I'm not really sure how to deal with that. I know it's something I have, I know it's something we all have, but how can you deal with implicit uh, bias? Does anyone have any tools?
I don't know if I have any tools, but once again, quoting Rob Carver's on this can be very useful. Obviously, this implicit fitting, implicit bias is the worst that one can have. So boils down to being diligent and honest about that. It's sort of unavoidable, even by his own admission. I don't know how we can separate it from our approach. Certainly, what we can do is just not cheat too much. So, for example, if you're testing a certain moving average configuration, and you figure out that is not great, but then somebody tells you, well, it's because you used the wrong moving average. Try to use, I don't know, exponential against instead of simple, something like that. And then you say, okay, well, I'm going to do that, but I haven't cheated. I haven't explicitly fit this data set, and so this is my out of sample. I mean, that's a really bad example of being let down by this implicit fitting process, and that's really, really bad. But what, on the other hand, what he's saying is it's making up a third category of fitting, and it speaks about this tacit fitting, which is when, through obviously good science and good experience and knowledge and intuition and all of that, you're sort of put into work a system which at the back of your mind, you know it works because it's been used by many people, many times. So this kind of tacit fitting or overfitting is endemic, but it's not as bad as cheating and doing implicit. So perhaps my take on all these things is I have to, since I can't solve the problem because it doesn't seem to have at least a very easy solution or very practical solution, is just keep track of what you're doing and always categorize fitting in all these three buckets, trying to kind of fill the implicit fitting as much as possible. Either explicitly fit something, I search for the best parameter that a certain model or system should be running with, or just fall back to tacit and know that perhaps the fact that a lot of people are doing similar things is not that bad. And yes, I mean it's overfitting, but it's fitting. It's letting bias through your data analysis, but it's not as dangerous as doing it without explicitly accounting for, and so effectively this is amounts to cheating.
That's interesting. The idea of copying someone else as a better version of this, tacit fitting, because if I will take the idea of copying someone else's fund or trying to replicate a published paper. If you are doing either of those things, you are inheriting all of the previous fitting that they have done, all of the trials, all of the data sets they have spoiled, all of the uh, kind of iterations they've put through the ringer and done again. You have no idea how many times they've done that. And talking about Marco Lopez de Prado and his deflated Sharpe ratio and keeping track of how big the Sharpe needs to be after a certain amount of trials. Honestly, it could get in the hundreds of trials that they've done, and the data set that you think is out of sample could have in fact been in sample for them. So um, I, I do these things. I think that you should inherit it. I think it is probably slightly more dangerous than you think. And the reason is what I had given, because, and not only that, if you're tracking a fund or someone writes an update to the white paper or like a version 2, they've obviously done work in between. So you will always be inheriting a lot of this like trial debt, like how many tries they had. And I think with following a fund, especially large funds, the chance that they have large teams with every data set that you could possibly purchase is extremely high because data is cheap these days. So finding an out of sample test for that type of idea, I find really hard, um, because they're probably still using it to this day. Or like if you've kind of like backtrack and you read their quarterly investors report, and they say, the volatility strategy that we have um, has been performing really well, or the long-term strategy as well. Or, I mean, we can take the Top Traders Unplugged podcast. He says group 1, 2, and 3. We know in general what is group 1, 2, and 3 strategies, and if we try to replicate the group 1, 2, and 3 strategies, um, we know that those have been fitted. We know that they're currently running. Niels is nice enough to let us know that the development has basically stopped at what point, but no other person is going to give you that type of detail to know. So if you were to try to replicate and you think that you've done a back test, anything up till today is in sample, in my opinion. Okay.
Yeah, so a way of accounting for that would be to, make specific provisions and understand that whatever results you're getting need to be adjusted. I understand what you're saying is that you can't explicitly and precisely measure how much butchering of the data has happened before that wonderful paper, wonderful article goes out. But I don't know. I mean, again, this is part of experience, I guess. It's I started started at a large investment bank. What we were doing, on structuring desks, what we were doing is just seeking, watching out for other people's clever ideas and replicate them. It's not that much more complicated. And of course, we had all the results that drove our decision. But at times we've been more successful than the people that launched the product. So that's not I'm not as arrogant as saying that every time you look at a strategy or at a paper or something, you're going to do better. But the point, and here it goes back to what we've been talking about, the reason for being open and all that. When you reinterpret something, chances are that you are going to do it slightly different than other people have done it. And so having the idea, having the sort of um, even that small tip or hint or suggestion that is hidden somewhere in the paper, I think is worth the try. And of course, that's not to argue with anything you said about. On the contrary, you need to be extra vigilant because it's at the very least tacit fitting to follow Rob's vernacular, but it could at worst be downright implicit. And of course, everything you said stands and actually needs to be amplified in that.
It reminded me of a quote. What, like amateur artists copy, professional artists steal. And I think that really comes down is true. I don't know how many people here use the like SSRN, archive, any kind of published research, or copying to find their strategies, or targeting like well-known risk premia, where there's dozens of papers written about it over 10 years or more. And I think that what Bruno P said was really good. That when you take the idea out of that, you will do it slightly differently. And I want to emphasize that point a bit more. And it goes back to something I was saying before about thinking in first principles. If you can understand what the basic mechanics and the principle that you're going after, that paper or that fund can give you that seed of an idea and you really understand it, you could potentially build a machine to capture that in a completely different way. And that thinking, I believe, helps make sure you're only doing tacit fitting as well, instead of implicit fitting. If you are copying the formulas exactly, if you're copying the strategy exactly as given, you will inherit all of their previous data nonsense, so to say. But if you're able to construct what they've done and you do something differently, but it's capturing the same thing, then actually you can measure the difference between those two. And maybe you can even find a third uh, factor or regression that will actually bring out what it is that you're targeting. And then you can build from there. And that is almost like you take the seed, not the tree, methodology, and I find that to be helpful to me. I mean, I've been doing this. I didn't think of it in this way. I think in this conversation we've been talking about implicit and tacit fitting and how this influences your bias. But I do think that method can help.
Yeah, I mean, it helped him massively. And once again, this is all Rob's work that I'm just repeating verbatim. I mean, repeating verbatim, I have contributed nothing to it. Simply stole it and run. Well, actually, he didn't even steal it because I paid for his book. So I think we're even.
Well, I guess this topic is kind of a bomb. Is there anything that anyone has seen in the markets lately that has been interesting, or any kind of topics that have come up?
I actually had a good chance to get into Olo Peter's work this week, and I copied his gambling experiment just in an Excel environment, and lo and behold, I got exactly the same results as he did. So it really hammers home this principle of path dependence, and it's quite a powerful concept. We all understand the principle of compounding, and we multiplicative processes, but I think the general trader has no conception of what the exponential function is, and I think we get into these massive problems when we talk in terms of growth rates or returns or average returns and things, and we sort of fail to sort of understand the asymmetry of it all, and how it's sort of on a path-dependent principle. It's a totally different premise to what expected value assumes. And no, I just thought it was very interesting, and just recreating his experiments, I think is probably a really good exercise, because it sure hammers home the principle in the back of your brain.
I'm a big fan of Ole Peters, and I do think the field of organic economics is a frontier that will change how we perceive um, average returns and expectation and things like that. I actually did do the same thing as you did, Rich, because and the thing that was so cool was not often in economics are you able to replicate someone's experiment and get the same result. It's like a soft science where it's not like chemistry or something where if like they replicated an experiment and I have the same chemicals and the same setup, I can replicate it. And he's really bringing that kind of rigor. The part I haven't yet wrapped my head around is how do we take advantage of this thing that's happening? We know it comes from a multiplicative returns environment. We know that you have path dependency. Um, we know you need to, and one of those things that you need to survive, and taking the small bet sizes does deal with that. But is there a way that we can um, do more than that? Were you able to come up with anything, Rich?
Yeah, look, I was able to boil down the principle to geometry, and I think the principle resides in what is the uncompounded geometry of that return stream, and certain strategies produce an uncompounded path, which is beneficial for compounding processes. And when I actually think, we always talk about systems and all of these things in our trading discussions, but what I really think does almost, over a long-term horizon, nearly all of the heavy lifting is actually done by this principle of compounding. So that therefore makes me ask the question, well, are there better uncompounded geometries than others that take hold of this principle and deliver better compounded returns over the long term? And this is where I'm coming to a very happy place in my conclusion of, divergent processes. When I look at the divergent profile compared to a convergent profile, I actually see an optimal uncompounded geometry. Now, this is not for everyone, of course, but in the majority of instances of the, when you look at the track record of the successful fund managers, you start getting groupings, and there's a very large grouping of successful CTAs who practice trend following, diversified trend following, and when you uncompound their monthly returns, you actually see that there's a very similar geometry. And of course, we translate that in terms of, well, they're very highly correlated, during particular market regimes, 2008, 2011, etc., 2020. We get this very similar profile, and this asymmetry sort of dominates the profile to the extent that the things like drawdowns, the things like periods of no growth are really inconsequential. And so when you look at what is the impact of the outliers in that series on this uncompounded geometry, you actually see that it's already got this significant asymmetry embedded in the series. And this asymmetry is greater than what I'm getting from convergent models that have long-term track records. I'm finding it hard to find fund managers with very long-term track records. So, 10, 15, 20 years, I get quite a few convergent cases, and then I uncompound their monthly return streams, and I see that their uncompounded geometry is less favorable than divergent fund managers. So that, to me, sort of is sort of like getting closer to this secret source. What's doing the heavy lifting? What's doing this fantastic long-term wealth story of this particular class of fund managers? And compounding is doing most of it. So this path dependence, or this geometry, uncompounded geometry, seems to be the clue that I'm sort of locking into, if that makes sense.
Totally. That's really interesting. So, like, I mean, in my head, I was thinking, okay, uncompounded returns. How could you backtest that? You'd use a fixed size backtest to make sure that all of the position sizes are the same, and then sum all of those trade wins together. You would be able to see that.
Yeah, that's
Um,
right. I, for instance, use a fixed dollar risk on an uncompounded base. So every trade has a fixed dollar risk, the same fixed dollar risk over a 20, 30 year time frame. That produces this uncompounded geometry. Then I say to myself, right, let's look at that geometry. Let's do all of these tests, and let's compound it by doing a percent trade risk on equity or on realized equity. And that then lifts it through the compounding. And then I say, well, let's reduce the impact of compounding to a monthly compounding or a heavy compounding on a daily basis or a trade by trade basis, and let's look at the impact there. And it's very interesting when you look at it from a geometrical perspective.
I feel it's easier to do this when your backtests are trade based and not daily based. I've had I've been questioning myself if about what's better to look at asset prices or models and treat them as assets and think about an allocation model in in a way that Rob Carver, for example, suggests in his books, or on a trade by trade basis, closer to what Jerry suggests when he looks at his when he questions about sample size. And recently, I've defaulted to the trade by trade backtests because I can, once I decide what's the model, what parameters I would use, then I overlap this decisions with a new one, a new system of equity equity updating. I mean, equity size updating. A new system that would tell me, okay, now you've earned 50%. You're allowed to update the trade sizes. I think this is a way to avoid the problem of non-ergodicity that's inherent in these other classes of backtests, if that makes sense.
Yeah, look, what I do in the absence, say when I'm looking at the fund manager's performance on a month by month basis, what you can do is you take the log returns, which therefore eliminates the impact of compounding on that return stream, but assumes effectively under the assumption that there's continuous compounding going on in that return stream. Now, whilst it might not be exactly accurate because some fund managers choose to compound monthly, some might do it trade by trade, some might do it daily. When you do the log return basis to do a comparison, it does give you a method to sort of almost compare apples to look at this underlying geometry of that equity curve.
Yeah, log everything, and you take the ergodicity out of the way.
Yeah.
But I mean, when I'm trying to decide on models on my back tests, then I don't have this. I can't allow myself to look at log prices because I don't trade log prices, and that's why things get more difficult. I mean,
Exactly, Bruno. Yep.
oh, and Derek, I have a suggestion. We had this difficulty of topic today. How about we get two potential topics for every next session, and when the session starts, we have an extra one in case that the first one flops.
Oh, I'm good with that, but since I'm the guy coming up with the topics, I need a little bit more creativity. So, I mean, I would be happy to do that, or even we could put it to a poll on Twitter. But please, people, send me your ideas. This is an open forum. I'm happy to put these ideas forward as well.
Yeah, having a poll maybe a couple of days earlier than the event is the best idea, because we see how much real interest there is for some suggestion that people come up during the session.
I mean, my issue is really just coming up with 3 options. The space is wide. I don't actually know that much about what our user base wants. Oh, I see someone has raised their hand. Welcome.
Thanks. I just was going to throw something out there, an idea to generate ideas, wondering if it could be like a quant book club or a quant, take a chapter in, one of the seminal biblical works of quant, and, everyone just refresh our minds on it and then kind of discuss something like that, or a strategy, that's in the public domain that we could discuss. Just throwing that out there.
I like that idea, Andy.
Yeah, that's awesome. I will definitely do that. I mean, cool blogs or a book or some strategies that are in the public domain. What level of stuff? Because we bounce from very low level stuff to some kind of high level stuff. I don't know, listeners out there, um, what level are you really looking for? Maybe Andy, you can tell me what you're looking.
Sure. I mean, I would say, I mean, I have the degrees and the studies, but as far as I would say lower level is best. I mean, it is best for me. But it's also, I feel like with a low level, you could always speak high level about it. But if it's high level, yeah, I mean, personally, a guy like me will probably, eyes will roll back in my head because I won't understand it. That's my.
All right,
I think
cool.
the limitation that Clubhouse imposes us of not being able to present stuff and we don't have the visuals, that hinders us to go very high level on a detailed basis. But I do think that when you take these complicated papers or publications and chew them for the uninitiated, I think that demonstrates competence, that demonstrates dominion on the topic, and I wouldn't be so restrictive on the selection of topics. I think we can talk about high level stuff, but when by I mean high level topics, but our language, I think it should be simplified, and that's the challenge when we choose, I don't know, a chapter from Advances in Financial Machine Learning, and try to talk in a simplified way. I think that's a huge challenge, actually.
Yeah, isn't that the Feynman technique, though. If you can explain something to a 10-year-old, then you've really mastered it. I'll be the perennial 10-year-old in this conversation. Again, I shouldn't belittle myself that much. I do have good masters and all that, but anyway, yes, good idea. Also to high level, but speak to the low level audience, such as my.
All right, I'll definitely do that for next week. I'll come up with 1 or 2 different topics. Thank you, Andy and Bruno, for bringing that up. And on Bruno C's topic before, this presenting thing, there we did discuss presenting a topic, like having someone do a 20-minute presentation about the topic. The issue is we all meet on Clubhouse, but we would need some kind of like PowerPoint thing. I will look into that as well, and maybe work with Bruno C on how to figure that out. And then that would give like everyone kind of a basis. But I totally agree with Andy applying the Feynman technique. I'll put up a poll um, over the weekend / Monday. I don't know for you guys, and then with the notice for the Clubhouse, and then that will give people a few days to read whatever chapter that is, if it's a book or a blog post. And then we can select from there. So thank you, everyone. Have a nice day, and I don't know, enjoy yourselves. Be good to yourself. Goodbye.
Thanks, Derek. Thanks, everyone. Goodbye.
Thanks, Derek. See you guys.
Thanks, everyone. Goodbye.
Okay.
Was great to see you all.